Hey everyone, it's Alissa Coram here. Now, with the market action turning from constructive to bearish on Thursday and more weak action today, that's increasing the odds we could see a third wave down in this correction. David Ryan, three-time U.S. investing champion and William O'Neill protege, joined IBD Live this morning by phone to talk about key levels that he's watching on the Nasdaq composite. Also updated us on a couple of short ideas he flagged earlier in the week and his thoughts on how to interpret sentiment gauges. Take a look.
When we're still discussing follow-through days, I just, the follow-through day just can't live by itself. It has to be combined with individual stocks. And,
Sure.
the individual stocks I have tried in the last couple of weeks just haven't followed through. The only area that just seems to be continues to do well and is moving up and holding fairly well today is the oil and gas area. But everything else, they have weak rallies and then they roll over. And so with that, I just kind of dismissed the follow through. I mean, because I put so much emphasis on the individual stocks that if I can't find anything that's working, then I just keep on going to more and more and more cash, and maybe look at the short side. But this is what I'm just looking at. If you look at the Nasdaq Composite that hit a high, I guess in December at 16,202. And then you look at the first move down, which I had to, that took us down to 12,555. And maybe if you go to if you go to the daily, you'll see that you can see those prices that I looked at. So that was a 22% drop. Then the market rallied. It had three really strong weeks right into the 200 the 200-day moving average. It rallied up to 14,646. And then we had another leg down, which took us down to 11,035. And so that was a 24% drop. So we've had two drops, 22%, 24%. And so what I start doing with what is going on today is really yesterday might have been the start. We had a 2-week rally, and which really wasn't that strong. And so now we're starting to come back down. We go through those lows at 1100. And if you take each leg, is usually the second leg down is the longest. If you put any credence into Elliott wave theory, or even if you go for 3 legs down, they're usually the same. They have the same amount of drops. So the first leg was 22, the second leg was 24. If this is the third one, it would take us down to 9,000, around the 9,850 area, which would be, I put in a 20% drop just to kind of give me some I don't know, guardrails or expectations where it could go to. And if you go back to the weekly, you'll see that 9,838 was a high back before the market rolled over for COVID. So those are just kind of a bigger term. Yeah, there you go. Bigger terms perspective of what I look at and try to give me, sort of anticipate if we get down there, if we, if it doesn't start holding, because this, in 2 days, this is another pretty bad break. And I would be very surprised if it hold and started turning and rally, especially when you look at so many stocks that have gotten hit and are now, underneath so much overhead. And so we just either need a lot of time, or we got to get down to levels where the market is repricing in all the earnings that are to come with higher rates and, world in turmoil with, Ukraine and things like that. So just my 2 cents of what I look for. And then and going to the short side, remember on Tuesday when I was on, I looked at 2 stocks. One was Nike, and I said, it was too early to short, but yesterday was really your spot to put on the short after it hits that 50-day moving average, like it's hit like 3 or 4 times before, and then starts backing off, and now it gaps down. So I would expect this to go back down towards the low. It might be too late to short here, but American Express, the same thing. AXP, that's where you want to get it, where it rallies up, it can't break through, and then it starts breaking that little base that it formed for the last 7 or 8 days. That's where you want to short. But for most people, it's just best to sit in cash and wait and study the market, see which stocks are starting to hold up. Because as you get into a third leg down, this is where the best stocks start holding, and they don't keep on falling to new lows. And, maybe maybe it's some drug stocks, maybe it's Lilly that seems to be holding up fairly well. But that's what you really want to concentrate on: what is holding up, what's doing well, and just hold a tremendous amount of cash, because as I said previously, your number one goal in a market like this is to lose the least amount of money possible, because you just want to have that capital for the next great bull market. This one, to try to try to stay invested is just, it's just torturous. because they rally for a few days and you're getting excited, and then all of a sudden you give it back in about 2 hours. So anyway, that's my 2 cents. I thought it'd give people a bigger perspective instead of looking so closely at what's happening today.
Yeah,
so.
I think that's great. And yeah, good to revisit, because it's been a hot minute since we talked about where we are with a potential 3 waves down. So it does seem like that's back in play with the resistance at the declining 10-week line for all the moving averages, and this week's undercut of the tight area.
Yeah,
you got to wonder psychologically, if we get below 10,000 on the Nasdaq, does that make people, oh man, this is really bad? And then that's exactly when everyone is like, oh, this is really bad. That's kind of when you turn. So yeah, I think there's some interesting things there.
And the thing that we have to break, which has been so ingrained into to every investor, the average investor, is that you buy on every big break. And that might have worked for 3 weeks if you did that in March, but now all those people are underwater, and you've got to break that psychology, because the market is this great training mechanism and gets everybody to do the same thing. After a while, they all catch on, but just at about that point, the market changes the rules and teaches you not to do that. So the thing I thought was the worst thing to read was that so much money was going into ETFs and on that decline into March. Yeah, they looked like heroes for a very short period of time, but all that money is underwater. And and so on this next break, are they going to go ahead and buy again and buy some more? I think people have to also go back and study the market and look at the long-term averages. Like the S&P 500 went sideways. I think it hit 1,000 in 1966. Did not surpass that until 1982. And that's 16 years of sideways action. And if you index just to the major market indexes, you might have, I'm not saying that's going to happen now, but it could sit there for a long period of time. The same thing, the Nasdaq itself, or especially the triple Qs, hit a high in 2000 and didn't surpass that until 2015, 2016. So just much bigger perspective, and it's best to have cash in a market like this.
Yeah, that's so interesting. With we're seeing ETF inflows, but ultra bearish sentiment readings. Something that I've wondered is, are the sentiment readings more of the smart money, and it's not taking into account, maybe more of the dumb money, as it were? I'm not offending anyone in this audience. We're all the smart money here in our audience, but is it not taking that
into account? Is it kind of skewing it, the sentiment readings? I don't know. What are your thoughts on that, Ed?
You're talking to me. Okay, yeah.
Or David, Ryan, any of you.
I don't have, sure David have better things, but it's just like, look, I mean, you can look at the primary indicators. I guess I just sort of like, they're not the, they were supposedly the bulls bears was very bearish, but the VIX wasn't necessarily that bearish. So the secondary indicators were sort of have been mixed. So, I mean, you haven't really shown much fear along the last few months. So it could go a lot. So that I don't know all the reasons. So I'm not sure what's going on, but those are just little. I use the secondary indicators more like tiebreakers kind of things, like as opposed to if the market is going down and the leading stocks are going down, that's what I want to know. And the VIX, is just like a little color to add to the story.
Yeah, it's your number one. What's your number one indicator? It's your own portfolio. Are you making any money? If the answer is no, then who cares what that what the sentiment indicator is? It's not going to help you if you can't find stocks to buy. That should just be kind of complementary. If you see the sentiment is very, very negative, and you see all these setups, and you're starting to buy stocks and they're making money, then you go, okay, well, it seems to be working. But number one indicator, can you make money in this market, and are you making money in this market? Outside of that, all those other things are just secondary and can be a lot of noise to get you to do some of the wrong things.
Some really great wisdom there from David Ryan. And if you want more of his analysis in real time, well, make sure you check out IBD Live every Tuesday morning. He's our special guest for the full 90 minutes, and it's always a great learning experience. So tune in for that, investors.com/IBD Live. And also make sure you subscribe to my channel so you can stay up to date on all the latest clips from IBD Live, as well as trader interviews and more. Thanks for watching.